Everyone, welcome back to the Mike Rosehart Show. We're live again for another episode and another day to talk about stocks, real estate, personal finance, whatever you guys want to talk about. This is literally the place to ask me whatever you want to ask me, and I will do my absolute best on the spot to think of the best solution that I possibly can on the fly. So, what's gone on? Yesterday, if you haven't been living under a rock, you would know that yesterday we had the largest single stock market drop in a day since the crash of 2020 when we were going through, basically a global shutdown, right? We're there again. The world is experiencing insane levels of inflation leading to a global recession. I think the worst we've had and will have probably in the last 3.5 decades. So that's catastrophic. Let's start there. I personally have been quoted, 4 or 5 years ago on like my buddy Matt McKeever's channel and other people's channels, but we were discussing how we didn't believe the government could sustain 7, 8, 9% interest rates. Home equity lines of credit right now here in Canada are on average around 7.5%. Commercial property now 8, 9% interest rates. At those rates, $1 million property is going to cost you like 6 figures a year just in interest carrying cost alone, not including everything else that goes along with it. So it's a scary time, but at the same time, it's an exciting time. It's a time of opportunity. And so let's talk through what's happening in the market. Specifically yesterday, where we saw at one point the NASDAQ was down almost 6% in a single day. Between real estate, crypto, and the global stock market, we saw $2 trillion wiped out like that. So we're in high inflation, but inflation's going down. Not as quickly as they said. They said it would be transitory. They were wrong. We knew they were wrong. Anyone with eyes can walk around and see that the price of goods is rising so drastically. Yeah, we can talk about the ETH merge. It's happening tonight, unfortunately. I'm very sad. I have miners, which are now basically useless. It was a horrible investment, but it was a learning opportunity. We'll call it that. Hopefully crypto, rebounds at some point and those can have some value. Anyway, so still bullish long-term on crypto, but I'm going back to talking about this for a second before I go back and talk about that. So thank you for bringing that up in the comments. I'll address it in a sec when I get down to that question, but we're talking about the high interest rates and how they're affecting things. Most businesses are heavily levered. Most homeowners are fairly heavily levered. If gas prices come down, that's awesome. But if rent's up 27% on the year and the payment on your car due to interest rates being so high, just assuming, let's pretend the car prices aren't up, they are up, and supply chain demands are causing shortages, which result in us having to pay more for our cars as well. It's passed on through the supply chain effectively. But let's just pretend that they weren't up, which they are. Your car payment's double from an interest perspective where it was, say, 4 or 5 months ago. So the average household, they've got their brand new car that they're financed. They're paying double now. If they have to have a new car, they have no choice, and they don't have the cash to buy it. If you follow my channel, which you do, you know you don't buy a new car, you buy a used car. And you ride the depreciation curve. You buy a car when it's in the flat portion of its depreciation curve, and you sell it before it hits the next leg down in its depreciation curve. And that mostly involves buying good quality cars that are at low mileage and selling them well before they reach 100,000 kilometers or 60,000 miles. We don't want to own a car past that point. Or if you're gonna own a car past that point, there'll be more maintenance associated. At least the depreciation curve in some cars results in you having a lower total cost of car ownership. But anyway, the average person, we're talking about person's budget, because supply and demand dictates, I guess, or sort of generally helps guide future policy decisions. And what we're seeing is that families are struggling right now. Their asset classes are being destroyed 3 ways to Sunday. You put your money in real estate, it's going down. You put your money in the bank account, it's going down. You put your money in the stock market, 2 trillion valuation, it's going down. We're down 28% on the year, and there's more pain to come. Where the hell do you put your money? If you keep it in cash, you're getting destroyed by inflation. You put it in any asset class, you're getting your ass kicked. So honestly, what do you do? Right? I get people messaging me being like, Mike, what the fuck do I do here? Like, my stock account's down 25% and inflation's up 10%. So I've lost 25 plus 10 to inflation. Let's call it a 35% loss. Personally, I think one place that is relatively safe is finding arbitrage deals or deals that are slightly under market value where you can park capital. I like real estate for that reason because, again, you can arbitrage. You can go out and take advantage of this situation, and someone will sell you their house at 60 cents on the dollar, 70 cents on the dollar. It's shitty for them. Maybe it isn't a great flip right now because the market isn't great for selling property, but you could buy that asset, hold it for 3 years, cash flow it positive, and you'd be solid, right? You'd probably, if you used a little bit of leverage, over a 3 to 5 year period, make 50 to 100%, right? And that's over a 5-year period, let's say, so 20 something percent a year. But that's a safe place you can park your money. One, I like that asset class. Even though real estate is down, if you're smart about it, you can buy assets for under market value. The same is true for businesses right now. If you can find a business to buy or invest in or build on, and you have some sort of competitive advantage you can develop, you can have I guess, what's the word I'm looking for? Like astronomical returns, I guess, or higher than normal returns because you're arbitraging some sort of skill. The stock market, what do you do right now? I think, personally, the most prudent strategy until we reach about another 5 or 10% pullback, when we test June lows and the market tests those 30% down year to date ranges, when we test that again, and I think we're going to break through that, I don't know. But if we did, if that happened, I think it'd be a strong sign to buy if you have a 3 to 5 year time horizon. So that's a great place to get into once we're into the recession, right? So I think that that's something that we can definitely look into. What I would do personally, if I was going to do an equities portfolio, is I would straddle. So I would, I would buy calls and be long, and maybe I would sell calls as well, and I'd sort of ride in between. Another way you can do it is you could sell puts and you could buy calls. That way, if it does rip down, then you're fine. You buy calls at enough of a point that you protect yourself against a major market rally. You can sort of strangle too. There's lots of different strategies you can use, but you could strangle as well. I know people who are selling calls as well. It depends on the day, but some traders believe in just collecting that time decay. And so you can do that basically risk-free. If you strangle the price where you say, hey, if the S&P jumps 5% or more, I'm capped out, I get no gain. If it drops 5% or more, again, I'm capped out, I get no gain. So it's the same as being in cash effectively because you lose nothing. If it moves within those bands, you make some money. Most likely it's going to move within those bands. If it doesn't, no big deal. You've set yourself up to not lose any money. So that's a great strategy to use as well. If you want to just sort of ride along, that'll generate you like a 5 to 10% return, almost risk-free. There are things like GICs and bonds right now are starting to look more attractive than they ever looked before, only because rates are so high. And this is the thing, the third item I wanted to mention was lending. I am heavily focused on lending right now. I think it is the safest asset class right now. And especially when you're lending to people who have high net worths, you're lending against real estate, that's ideal. Real estate, I think, with say 20, 30% margin. So if you're lending against a property worth 100,000, lend 70,000 against it. And that way you have a $30,000 cushion of their equity that can get lost in market downfall, further price depreciation, et cetera, so forth, costs to dispose of the property. It's effectively a risk-free. I think we won't see, like here in Ontario, we've seen a 28%, 25%, depending on the city, drop in the price of real estate from February to now. So we've already dropped 25, 30%. I think another 20% will put us at a 50% drop. That's a halving of the value. If it was $1 million property in February, it's now worth 500. If we get to that point, I think it's pretty safe to say that lending against that asset class, that 70% loan to value, is really quite safe. The government will step in at some point and stimulate before they will see everything sort of collapse, right? Because our banking system is one of the larger contributors, and real estate in general is one of the largest contributors to GDP in Canada. They will step in at a certain point. They need to be serious about inflation. I get it. They're going to, I've talked on this channel at nausea about them being in a rock and a hard place, right? So as they continue to tighten and less stimulus and higher rates, we end up in a situation where, it's if they don't raise rates, inflation runs wild. If they raise rates, then it crushes the economy, and then eventually they have to lower rates down and stimulate the economy. So we're going to get a balanced out here. I think the long-term growth rate's like 3%, so we should see prime float back down to around 3. We had historic lows in January. We could see that again. We may not ever see those lows for the next 5 years. It's possible we stay just a tad above those. Where we are now, there's a little bit more room to go up, but soon we will be into a really bad energy crisis this winter, along with a number of other factors that I think will drive rates down in the spring, in which case we will see returning back to where we are now, I think, by the summer. And so, is it going to get worse? Yes. For how long? I don't think very long. We see very quickly how much pain is inflicted with each rate increase. So that's just my 2 cents. I think lending is a great place to be, again, because I think that you can go out there and put the time in and find a great, real estate operator who is still, crushing deals, who has a great history of doing this, and say, hey, I know how hard it is to get capital right now. Reach out to someone who's, a real estate operator and say, hey, I understand how difficult it is to get capital right now. Instead of you paying me 8%, how about you pay me 15 or 14 or 12 or whatever, 10, but more than you were paying before, and I'll be that guy that funds you. And so this is a good time to be able to get out there and get great returns while mitigating risk. And again, I think real estate operators are a great lending opportunity. And so I like lending against real estate more than I like lending against businesses or bonds or lending to the government. Again, I don't love GICs either. They are paying well right now. You could lock in a GIC and get a fairly good return. Unfortunately, it's not beating inflation, right? Inflation's still 8%. So anything you're investing in where you're guaranteeing yourself to lose to inflation, it's kind of shitty. Not as shitty as being in the markets and watching it take a dump, but I think that the markets come back, whereas the GIC it's never going to come back, right? Like if you hold that property over 5 years, you win big. You hold that, the S&P 500 over 5-10 years, you're doing great, right? But if you hold a GIC, you're getting your 5%. Awesome, right? There's going to be a point at which the government starts stimulating. We're into a recession, and at that point, rates start coming down. That GIC is great because GICs are now at 2 or 3%, and you're at 5. That might feel awesome, but you're capped at 5. And for me, 5 just doesn't do it. 6 just doesn't do it. 7 doesn't even do it. I need to see double digits at least. And given my robust network, I am able to, and I do take a little bit of risk, but I can sometimes find an off-market deal, assign it to someone, and fund that deal. And when that happens, that's just a beautiful marrying of two things. A deal that I understand that's clearly undervalued, that has a clear strategy to make great money for the buyer of that deal. I can make an assignment fee, and I can fund that deal with my money as a money partner, effectively, or if I take equity, or doing lending where I secure against the house. So that's a great opportunity. I think, honestly, it's the place where I'm feeling the best. I have my crypto investments. I have my equity investments. Again, I'm still buying properties where it makes sense. I'm still flipping where it makes sense. I'm just very cognizant of running my numbers and making sure that there's a lot of margin there. If I have to hold, I can. Making sure I have multiple exit strategies. Very prudent to run your numbers very tightly. Depends on where you're at in your journey too, right? Like if you have a great job and you're making good money and you just want to park some cash and get a passive return, you could also buy properties right now at 20% discounts pretty much across the board here in Ontario and get better cash flow than you would have 4 months ago, 5 months ago, and then hold that property for 5 or 10 years, in which case the property will probably double in value. Thankfully, or I guess in large part due to inflation, which hasn't been transitory and is continuing to exist. They're getting it under control, and they will get it under control. When inflation is back down to 2 or 3%, we will be in a full economic recession. We're technically in a recession now, but a real, in 2008 is coming. That's happening. It's just a direct byproduct of raising rates between 7 and 10%. Shit starts collapsing. The government can't even service its own debt. That's why they have doubled the workforce of the IRS. They're going to start auditing, and they're going to put in new implementation measures to collect more tax revenue to pay for the cost of all the debt, all the money they borrowed, right? So it's just, it isn't sustainable. The government can't survive. But the problem is they're in a rock and a hard place in that many countries right now, like Pakistan or Argentina, or there's Venezuela, there's a whole bunch of places right now in the world, a list of 50 countries that are going through hyperinflation at 30, 40, 50%. And they're just flocking to US dollars. And so there's a challenge right now with global inflation. We are now more connected than we've ever been. It'll be a deeper and more painful recession, I think. Another, catalyst or positive thing is if things between Russia and Ukraine they mend a little bit and maybe sanctions are lifted a little bit. That would be, some positive headwind for the market. I think that we could also see, China and Taiwan stresses kind of continue to friction, and that could cause a bit of waviness for this next bit of time. But yeah, I feel a lot better about buying the stock market or buying properties right now than I did in January. I will state a fact. I purchased no properties from September 1st until June. September 1st, 2021 till June. I bought nothing. It was 9 months of I passed on every opportunity. Just throwing it out there. For Mike Rosehart to buy no properties for 9 months, I was saying on my stream, real estate isn't looking great in January as things were frothy. I was selling. And I don't know, people, they listened. Some people listened. A lot of people messaged me, were like, Mike, you were spot on. Everyone, all the real estate gurus were like, keep buying, buy for cash flow. I was like, buy for cash flow. House hacking makes sense. Buy a property to house hack. That makes total sense. Then you get your living cost to zero. You're going to hold it long term. It's fine. But if you're going to be flipping or you're going to be acquiring a lot of assets and deploying everything you have, might be prudent to really hold back until you can find the right deal. And because the market was where the market was, there were no deals. Nothing met the metrics. And that's why I didn't buy anything. And now a lot of shit's meeting the metrics, and I'm adjusting the metrics further due to macroeconomic factors, which are looking rather bearish in the next 6 months. But long term, again, still looking great. Let's go to the Q&A, guys. Let's blast some of these questions that you got. First, 2 weeks in a row. Hey, right on, Port City. Phillips family. Hey, how you doing? Welcome. Stickman Finance says, more property price drops. I'm looking at Oakville. It seems slow dropping compared to other areas. So it's very regionally specific. Real estate doesn't necessarily follow one trend. One city could be up, one city could be down in the same province. So it's hard to generalize, right? Like Alberta might be doing better because oil is ripping right now, right? And pushing the market factors towards the upside for real estate, despite the fact that rates are rising and affordability is difficult. All of that, right? Like it's definitely something that I'm cognizant of the fact that each market is different. So we'll put that caveat out there. I don't know what market you're in, and I don't know the specifics, but oh shoot, lost my place. Oakville specifically was the city, yeah, Oakville. Okay, so Oakville, from what I understand, it tends to be a lot of foreign capital. More importantly, it tends to be very expensive properties. And one thing to note is that over the last 5 years, we've had more millionaires than we've ever had before. A lot of people made a lot of money. Crypto ripped up in ways we've never seen. The stock market roared 100%. Housing prices doubled effectively over 4 years, right? So that was very bullish for people who own luxury properties. So a lot of these people bought these houses for $1 million. They're now worth 2, and the house has dropped to say worth 1.5, and no one's selling. You're like, why are prices not falling in Oakville and in that range? Because those people don't need to sell. They're wealthy, or they own it in cash, largely. Maybe they have a small HELOC. And so it's not largely affecting them that as much as, say, someone who, in Toronto got their parents to co-sign, put everything together to buy a house, and they're right at the max of their budget, and now rates on their HELOC have doubled. So their interest payments on their HELOC are double. They're paying $2,500 a month, and now they're paying $5,000 a month. By the way, lots of people messaging me with those stories right now, being like, hey, my home equity line of credit was $2,000 a month to carry. Now it's $4,500. What the hell do I do? I'm like, oh, you didn't think rates would get this high? Hell, neither did I. Neither did I. But we should always run our numbers to make sure that we can handle these types of sensitivity analysis. If this does happen, are we going to be okay? And do we have those contingencies? That's why I talk about having 2 to 5% of the value of the property set aside that you can access, even if it's in an investment account, right? It's very, very important, I think, to sort of have those reserves there when investing in an illiquid asset like real estate. But yeah, a lot of people right now are, the type of people who don't need to sell in that market. So that could be why you're seeing that in that market. Other markets I know too are heavily cash buyer focused and, largely owned by say, there's certain cities that are monopolized by hedge funds and pension funds and people who have a lot of cash, investors who are cash investors who are okay with a 5-7% yield. And so real estate is a great place to park money and make 5-7% yield. If you don't plan to sell it, you can hold that property for a long period of time and generate those kinds of yields. now more than ever, right? And so those buyers are coming in like they're quite interested still to gobble up the supply, and we still have a supply demand um, imbalance, right? So what happened here? Oh, I clicked the wrong button. I removed him as a moderator. There we go. I thought I booted him, but I didn't. Jonas is trolling me here. Says, thanks for that, buddy. I'm glad your sister's your mentor. I was also your mentor at one point. Don't forget it. David says, hello from Alberta. Hello. Port City says, just locked in a refi pending appraisal at 5.89%. Yeah, I'm just throwing this out there for you guys. I'm looking at a mortgage right now as well. And the variable rate now that I was offered, I think it was around 5%. And the fix was at 5.14 for a 2-year fixed. And I'm like, geez, do I lock in for 2 years at 5.14? It's almost the same rate as the variable. The thought here is this, my prediction. This is my rate prediction. Who knows what will happen? But I think we get another rate increase in October, another one in November. We get another rate increase probably at the start of the year. And then we're in a full-on recession. Shit's fucked because HELOCs are like 9 and 10%. No one could carry anything. We're getting defaults on cars, defaults on houses. People just are struggling, and they reach out to the government. And because people's housing expense and their car expense are their two largest expenses, and they're largely tied to interest rates, along with the fact that everything else in business is tied to interest rates, we will be in a full-on recession. I think that will crush demand enough that inflation will fall. As soon as we have that data that people are losing their jobs and inflation's down, demand is down, they will say, oh shit, we need to stimulate. And they'll drop some sort of stimulus bill and they'll pass it out. And that will let the money printer print. M2 supply for money has actually been relatively flat, pretty good actually. They haven't been printing a ton of money, which is like for the first time in a while, because in 2020 and 2021, they printed more money than they printed in the last 2 decades before that. It was like just off the presses, so much printed money, which the economy has to grow to the money supply. So we needed to grow, we still need to grow to meet that money supply, or money supply needs to shrink. That's what they're doing with the tightening. So anyway, my forecast is by the spring, we start quantitative easing. We start letting the rates, drop down. Prime will drop back down. Your bank prime on your HELOC will be like, it'll go from like 6-7% to like 5 again, and maybe even 4 towards in the fall. So on a 1-year fixed, you'd win for sure, locking in at 5% right now, because the variable's at like a little over 5 for most of the bank rates. And so for a rental property. And so that's something to, when you're running those numbers, it's like, okay, I lose for 6 months on the variable, maybe 9 months, maybe a year, depends how long it takes to correct everything and really get inflation down. Their primary motive isn't like the Bank of Canada or the Fed in the US. They don't really care about they do care about the economy, but their primary focus is beating inflation. And so if that means that there's pain in real estate, there's pain in the economy, that politicians are all pissed off, people are all pissed off with them, that's fine, because their job isn't to watch the stock market. They don't give a shit. As we saw yesterday with minus 6% of the NASDAQ. They don't care about that. Their focus is getting inflation under control. Back to the guideline target of, basically the currency devalues at 2 to 3% a year. 3% is like kind of what they would be happy with. So yeah, that's definitely something that we're cognizant of. And so I think, to sum it back up, I think a 1-year fix is a no-brainer if it's at least close to what the variable rates are right now. So if I was choosing between 2 mortgage products and one was a variable and one was a fixed for 1 year, I would go with fixed for 1 year. If the gap spread wasn't more than like 0.25%, I would say that that'd be in your favor. On the 2-year, it's difficult. And I'm noodling on the 2-year because I'm like, on the 2-year, in year 2, you might win for the first year being locked in at, say, 5.14, I think is what I was talking about getting. But in year versus the variable, right? The variable will go to like 6.5, maybe at the worst. So there'll be a bit of a gap where you'll win on the fixed, but then in year 2, it'll be brutal, right? Rates will come back down to 4, maybe your variable floats down to 3, and you're like still stuck at 5.14, which is like a 40% difference in the cost there. That said, variable products are cheap to break out of. So if you're planning to refinance it or sell it or flip it, you have options. You can go back and refi it almost no penalty. Whereas a fixed, you have a lot less flexibility. So it's always that. I always like variable over fixed for that reason. I wished I had fixed in some stuff in January. I had the option to, and I didn't. It is what it is. Thankfully, I can afford it. Thankfully, I've run my numbers so that my properties are fine. And my cash flow is, I have more cash flow than I need. So it's not gonna crush me, but it is painful. Like, I'm still feeling it. I'm still wanting to cut spending, and I'm still wanting to, um, you know, pinch my pennies in these times as well, right? And that's what the Fed wants you to be doing, right? They want you to react that way. They want you to stop spending so that demand falls, so that inflation falls. Brock says, hey, I have a couple rentals with variable mortgage rates and a HELOC of 5.7% currently. The goal is to buy a single family home for myself soon. Should I pay off the HELOC to assist in qualifying? It depends. Yeah, I mean, if your goal is to get some really cheap mortgages, right, or get some mortgages going, and paying off the HELOC allows you to buy the property, then you just draw the HELOC down again, right? I always, whenever I'm going for a financing application, I pay off all my debt, so I have zero debts, and I go in there, and then later you can draw it down once the mortgage is funded, because who cares? So generally, that's a good idea. You should want to do that. Brock says, for new mortgage for single family house, question mark? Thanks. I guess the other part of the question is, HELOC goals to buy single family for myself. It was just the one question then, I guess. So yes and no. It depends on your specific financial situation, but probably. HELOCs are also slightly more expensive too. I think that if you get a fixed and variable rate mortgage, it should be like at least 0.5% to 1% lower than a HELOC. You just have less flexibility with a closed variable rate mortgage versus a HELOC that you can pay off and use anytime you want. The nice thing about the HELOC is that you're, say you got approved at 80% loan to value, you're always at 80% loan to value. My favorite product, by the way, is a variable rate or a fixed rate mortgage with a HELOC on top. So they'll say half of it is a mortgage, half of it is a HELOC. As you make your payments and you pay down your principal, your HELOC grows, so that you're still at total 80% loan to value. You never actually pay it down. You just grow your HELOC room over time. That's the best, because you don't ever want to pay down a mortgage. Ideally, you could just refinance a property all the time. So those types of mortgage products where you have a mortgage and a HELOC in one, that's the way to go. So that would be my advice for you, is to get the product that is a HELOC a mortgage primarily, say, 80% mortgage, 20% HELOC, and a small HELOC as well, that grows over time. As you pay down that mortgage, the HELOC room grows. That way you have access to all that capital whenever you need it. Why would you ever want to pay down a mortgage when you can get access to debt at a lower, assuming, and this is, I might have to eat my words for like a 6-month period coming this January or this, November, December. There might be a period where yields on properties or whatever investment you're looking to invest into could be, in a major city, let's say, like Toronto or Vancouver, the yield on the properties, the cap rate, is lower than the cost of the debt. And that's a rare anomaly. It shouldn't be that way. The market can't sustain that for a long period of time. It would be like an inverse relationship that you wouldn't normally want. But in those situations, it actually doesn't make sense to borrow against your HELOC or to not pay down debt. And so that's where the philosophy in the 80s from Dave Ramsey and all those guys came from, paying down your mortgage, because it was a 19 or 20% interest rate. And so you have mortgages at 20%. If you pay that down, you got 20% after tax return. That's the same as making 30% in the stock market, right? If you're going to be taxed on it at 50%. Well, I guess stock market is 25% tax. So it's really like getting a 17 or a 24, 25% return in the stock market. But still, it was a good, solid return to pay down your mortgage debt. And people were getting their shirts, losing their shirts. And it was prudent advice. It's not prudent advice if the cap rates are higher than the debt. So as long as the cap rate's higher, you're good. Hopefully the price of real estate falls to the point where the cap rate is 8 or 10%, and you're still borrowing at 6, 7, 8%. It's still under, and there's still a spread there. Then it's good to apply debt. When you apply leverage to assets that produce more than the cost of the debt, that's a win. When they can self-service the debt, that's a win. Long term, when no one else is going to be able to buy too, at the bottom of this market, credit's going to freeze up, right? It's going to be really hard to get. It already is harder to get, but it's going to be even harder to get. The higher rates go, the harder it is to qualify, et cetera, so forth. It's going to be tough to get the capital. They're already finding that. Fintech companies right now and tech companies are going belly up because they can't raise funds. It's hard to raise funds when government bonds are paying 7%, when you can go get mortgages on property at 60% loan to value and you can go fund that at 10%. It's hard to raise capital for a maybe venture that might go somewhere that for 5 years might make you zero. Well, inflation's running crazy, right? So it's hard to raise capital. And so for those people who do, and get the opportunity to do things right now, I think in a 5-year period, you'd be really, really glad that you did. So I think they'll be at this bottom. It'd be a great time. One of the only times, and mark my words, one of the only times in history where we get a chance to go from basically this is the time when you get to be a millionaire. Everyone talks about the 2008. It's like, oh, I wish I would have bought in 2009, 2010. We're having that again. Hallelujah. It's been 13 years. I've been waiting for one of these. I get a chance to 10x my net worth with some leverage. I'm excited for this opportunity. So as bad as things are and as much fear is out there, when fear is maximum, when it feels like it will never end, when it is at the darkest point, when no one can get financing, when rates are so high that nothing makes sense, that's when you fucking buy. That's when you get out there and you load up on properties, on assets of all different kinds. Be diversified, run your numbers, make sure you're careful in what you're buying, but definitely that's when you want to buy. So that's my 2 cents. Let's do some Q&A here. See a whole bunch of questions I haven't gotten to. No problem, Brock. Happy to help. This message got retracted. I don't know what it was. Some sort of question. Oil and gas has outperformed this year. Yes, David. Mostly due to the fact that we have a war between Russia and Ukraine, and there are supply side issues. As part of the focus and push for EV and all the green shit is because we have an actual crisis. We don't really have a crisis. It's sort of a manufactured crisis. There's been a reduction in production for some time now. And so it's, low prices for the last couple of years have really driven down investment into oil and gas, right? So that sector was not producing a lot of extra reserve because prices were not good. It was not that profitable. It's like with miners right now. Let's crypto miners. People are going to start turning off their miners, going to start throwing stuff away. No one's going to be investing in that space. And then when crypto rips off again, there's not going to be a lot of hash rate, and it's going to be extremely profitable for those people who are the quickest to act, who still have machines, right? People are all going to stop investing. You're going to see a lot of crypto miners go belly up, especially big miners. As Bitcoin prices fall below 15,500, you start turning off the miners during the day on peak power, right? Or if you have a fixed rate price. Anyway, my point is, the point when you want to be investing is at that time, right? When there's the most blood in the streets. So definitely an opportunity zone we're going to be coming into here. I'm excited for it. I still have capital, thankfully. Yes, my net worth is affected, just like everyone else's. I wish I invested heavily in oil and gas. Unfortunately, I didn't. It's like 5% of my portfolio. So I did make a little bit on some, Shell stock and whatever else, but and some Enbridge stock and other things like that. But yeah, I mostly lost out on that. Someone said buying DRV soon. I'm just going to say this. If you are still short, and real estate has fallen a lot in Canada, specifically Ontario, where I am, not as much in some places like Florida, where it's still up year to date. It's down a little bit month over month, but year to date, still up. There are indexes and ETF indexes like some of the ones mentioned where you can go and there's directional 2-3 times bear. So it's no leverage, but you're directionally 2 to 3 times opposite into the housing index. So if house prices fall 10%, you can make 30%. There are indexes you can go and buy. So if you believe in that, you're like, hey, it doesn't make any sense because no one can qualify at 8 or 9%. How are people going to pay $500,000 for a house? The same house is $500,000 in January. How are they going to pay for that now when their mortgage payment is 2.5 times what it was in January? Shit doesn't add up. Doesn't make any sense. Why are people going to buy properties in LA where the cap rate's 3? That means the property can generate a 3% return if you bought it in cash, net of expenses. When the cost of debt, if you apply debt to that asset, is 7%. So for every dollar you put in a mortgage against a property in, say, LA, you're going to lose almost 2.5 times. So not a good situation to be in. You might run through some of those things and think, there's definitely some downward pressure here. Higher interest rates is going to hurt real estate. And so you could potentially make a bet on that. A lot of people already have those indexes. Some of them that are directionally bear for real estate are up 40% year to date. Again, they're 2 and 3 times levered in some cases, or 2 to 3 times performance to the opposite direction. So be careful with those sorts of things, because if real estate ever ripped up, which I don't think it will in the short term, in the long term, definitely not a good investment. But if you're going to short-term hedge, like let's say you had 10 properties right now, and you're like, shit, Mike, I don't want to sell. I have a huge tax liability. What the hell do I do? I'm just afraid shit's going to crash. Or I'm doing 5 flips right now. How do I hedge? I'm like, go buy that ETF. Go take 30 grand and put it in that ETF. And if real estate falls 30%, your ETF's up 90%. And so that, say you put 50 grand in there, it's worth 100 grand now. You take 100 grand out and you cover your losses that you had on your flip. So there are ways to hedge. If you're afraid right now, you can continue to operate in this environment, but hedge. I continue to own stocks that I like. I love Intel, as an example. I love Amazon. Intel is like one of my favorite companies, trading at like a 7p. I like Meta. I know a lot of people don't like Facebook. I like Meta. I like what they're doing with WhatsApp and Instagram and Facebook. They're cash flow machines, and I think the metaverse is the future. Who knows if they'll be the leader in that space, but I also just believe that like Zuckerberg's Eye of Sauron mentality will lead to long-term fruit. And so anyway, also great PE and great price to earnings ratio. But I own those stocks. Do I think that short-term they're going to get crushed by interest rates? Do I think that we're going to have another 10, 20% pullback on the price already, even though Facebook's down 45% already from the highs? Yeah, maybe 50%, 60%. I have to look at the actual like peak of where Facebook shares were, or sorry, Meta now. Yeah, possible, but I'm hedging. I also have a $3 million short on the NASDAQ. So when the NASDAQ moves down, I move up. And that hedges my position as I continue to hold long positions that I want to hold for the next 5 years. Short term, I'm holding hedges. And so yesterday, as an example, I made $80,000. The market went down, lost $2 trillion in market cap. I made 88 grand yesterday because I have a net short position that covers all of my long positions. So the market moved down 6%. I moved up, say, 2% or whatever it was. I'm up 8% on the market because I'm hedging. Now, that means that if the market rips up, I could lose because I don't get all those gains if the stocks just rip up. I don't think we're there yet. And so I'm looking at macro indicators, and I'm okay to give up the potential. Like maybe I'll lose out on 5% of if it ripped 5% and I wasn't ready and I didn't close out my shorts. I'm okay with that choice to hedge because I'd much rather lose out on 5% potential gain than lose 20 or 30% of what I already have. I have a lot and I need to preserve what I have. That's my mentality, is don't lose money. Follow what Warren Buffett says, and the most important rule of investing is don't lose the principal. If you lose 50% on your investment, you have a 50% loss, it takes 100% gain to come back. Like, it's a lot harder to come back from a loss. So cut your losses quick, hedge, be careful, diversify, guys. Solid financial advice right there. Next question. What do you think of rent to own as a real estate strategy in the current market and overall? It can be great. It can be very predatory, so be careful. There are a lot of operators out there who are predatory in nature. Because it is so predatory and it is private and you can arbitrage it, you can take advantage of both the renter buyer, that's what you call the person who you're putting in to do the rent to own. We can put in ridiculous fees. You can take large deposits from them. You got to remember that like 3/4 of rent to owns never come to fruition. By that I mean 3/4 of the people you put in a rent to own never buy the house. And so majority of the time you just keep their deposit and they pay an astronomical rent that's double market rent or whatever that's going to a deposit account, and at the end of the day you end up keeping a lot of that in fees if you do the contracts properly. It's not very ethical. Well, I guess in some senses it is. It's the renter buyer's fault for not fixing their credit over the 3 to 5 year period. You give them the keys or the fishing rod and they don't fish because people are inherently lazy, inherently stupid. I hate to have that negative philosophical view on society, but like just dealing with the bottom half of society, I gotta say, people are generally selfish, lazy. They'll take the easy route, which can be a good thing in some situations. But people want to enjoy life. They don't want to work. They don't want to invest in their future, and they sure as hell don't know how to delay gratification. They would rather have a sub now than delay and have 2 subs tomorrow and go hungry today. It's just what it is. So rent to owns can be a good investment, especially in this market. But be careful. If you don't buy smart, if you are bringing an investor on and you set something up where the structure is such that the investor could pull out on you, then you'd have some issues potentially with setting up the deal. Where I've seen things go wrong. Where else have I seen things go wrong with rent to owns? I've seen people not do proper contracts, and the house got destroyed by the renter buyer when they couldn't buy the house, and they got they didn't have a large enough deposit. They weren't building enough reserve over time. I've seen things go really bad. I actually bought a property off a rent to own client. They sold the property to me for a 40% discount. They just walked away and lost a bunch of money because the renter buyer started fixing the property up, and then it was halfway done. So you can't even MLS that because no one can put a mortgage on it. It's not bank financeable because the kitchen's ripped out and the bathroom's ripped out, which is like 20 grand to fix. Who cares? For me, I can get it operable, no problem. Close on it with a private mortgage or close on it with private funds, and it's not a problem. But it was a problem for them. They couldn't easily liquidate it, and real estate is not very liquid. It's illiquid as an asset class. With stocks, I can get money like in 2 seconds. So that's something to kind of think through. Definitely something to think through in these times. All right, what else did I have to say? I lost my train of thought. I think I answered that question satisfactory enough. I'm just spitting out some quality info here. So if you're getting some value from this, hit the thumbs up button, jump in the comments, let me know you're getting some value. It'll tell the algorithm that, you know, I actually release value. Next question was from Mr. Pipton. How you doing, Mr. Pipton? Anyone is looking to lend, I have some projects that I'm looking to raise funds for. There you go. So shoot me a DM. I know lots of people who have capital right now who are looking to deploy it. Are you willing to pay what people are wanting to lend at is the question. It will cost you. If you don't have a robust, you know, social media portfolio of showing daily what you're doing and what you've been the last 5 years, that'll hurt, I think, your chances of raising capital. So that's one thing you can do if you want to raise capital, is to work on that. Document your success, right? If you've done 20 or 30 flips, show that. If you've got a strong net worth, show that. All those things help make borrowing a lot easier, right? Think about how the bank would look at it. As a private lender, I'm more looking at the quality of the deal as well as the quality of the borrower, but from a different perspective. I could care less if you have a job. Like, that doesn't mean anything to me. You could lose your job tomorrow. And if the bank's fixated, like, you have a job, we're good. Oh, you have $10 million, but you have no job? Oh, no, sorry, we can't lend to you. I know you can buy the property 10 times in cash, but like, no. We like this guy who has $5,000, credit card debt up to his eyeballs, but he has a really good job. Like, that's perfect. This is like the ideal candidate for us to give 5 mortgages to. Makes no sense to me why the banks are structured that. Well, okay, it does make sense to me. The regulators want people to pay more tax. And so they're telling the rich, hey, you're rich. You should have lots of income. Declare the hell out of it, pay tax on it, take it out of your corp, and pay yourself a personal salary, and then we'll give you mortgages. So that's why it's designed that way. But from a risk management perspective, I'd much rather lend to someone who's rich than lend to someone who's poor with a job. Lose a job in a second. It's hard to lose, like, if you have like $10 million in assets, it's hard to lose all that. You gotta really fuck up in a big way. You can't spend it. You have to make some really bad investment decisions. So then looking at their history, if they're a good operator, you're like, this person's a great operator, you know? That comes into play. Shauna says, so a house listed for 1.5 million, then relisted 2 months later for 250. It looks like they're trying to get a bidding war. Yeah, I mean, that stuff's happening for sure. They will try the $1 approach, you know, and people will pay whatever they'll pay. In some cases, that works out well. In other cases, it backfires. So it depends on how the pricing strategy goes, how the marketing goes, and the traffic driven to that. I've seen some places listed low, and then like one offer on offer date. It's like, oh shit, this backfired. And so then you might be able to get the property for 100,000 under what it's worth. List price doesn't necessarily dictate what it's worth. Hey Mike, I'm assuming it's best to buy bird properties at low prices with high interest rates and refi once the value increases and the rates decrease. That is a good prudent strategy if you can buy at the bottom. You buy with private funds, and then by the time you're done the flips, or the burrs, sorry, you're all stabilized, you go back to the bank, hopefully rates are lower, or if they're trending lower still, you go variable, and then within 6 months of that, you're back hopefully to lower rates. So the mullet, 100%. Yeah, life's good. I haven't cut my hair in a year and a half, just been letting it grow. Whatever, guys. You know what? I have no one that I'm accountable to. Yes, it's correct. Good question. Dripsat says, should we buy houses cash on Burr due to a recession? I still think financing. If you can't do a deal with debt, you shouldn't do the deal. That's my thought. You can do deals in cash. I do often do deals in cash. I have one closing potentially tomorrow that I have to do in cash now. It's a 50-acre farm near 15 minutes from downtown Kingston that we're closing. And, you know, we had financing lined up, but the seller wouldn't close. There's like 4 months of delays. They're just refusing to leave the house. And now they're like, hey, we've left. So now I have to scramble to find money. The mortgage wasn't lined up. It's just a gong show. I'll close in cash. No problem. I didn't have time to get the private together. I actually didn't expect them to close. I was more likely expecting to sue them. But yeah, so there's an example of like where I'll have to close cash. Could I throw a mortgage on it if I needed that cash back? For sure I could. But again, I can just take cash out of my stock portfolio. No big deal. It sucks to close some positions, but it is what it is. Clash says, what do you think is the best time for someone new to come into the market and buy a first deal and go through this high rate market and then refinance once it comes down? To answer your question, what do I think the best time is? We don't know where the bottom is. No one knows where the bottom is. So we are in a trough. Where does it fall at full bottom? I don't know. Can you negotiate great deals right now with no competition? Yes. Could you buy if you're going to hold it for 5 years, buy something now. like in the next couple of months. Specifically, the next rate hike would be a great time. I think that'll be when max fear sets in this fall. We do 1 or 2 more rate hikes. That'd be the best time, I think, to get in. We could go a little further, it could get a little worse, but it's hard to be perfect with timing. If you miss it and the market's rallying, then you're competing against all the people who are waiting on the sidelines with cash until they see the Fed start lowering rates again. Those people are going to start flooding in, right? So you want to get just before them so you can negotiate the best terms, the best price. But make sure you look at a lot of properties. Make sure you put in a lot of offers. Don't just buy the first one you see. How can I reach you to find some good deals in the London area? At Mike Rosehart on Instagram, Mike Rosehart on Facebook. On Facebook, I have a blue check mark, so you can find me there. It's the real me. There are a bunch of fake accounts on Instagram, so don't get tricked into following Mike Rosehart. Mr. Shart has been reported 350 times now by 350 of my followers and me. I'm blocked, so I can't see his profile. For some reason, Instagram actually responded to my report and said that he was doing nothing wrong. He scammed probably a dozen people in my name. That's unfortunate. He's copied every single one of my photos and uses my brand to try to scam people. I don't like it. I think Instagram should work on that. Hopefully, Instagram gives a blue check mark so then people know to find me on the blue check mark. But on Facebook, I have a blue check mark, so you know the real me on Facebook. You can reach out to me there. Also, rosehartcapital@gmail.com. We can do a rental plan if you want. U.S. does not produce any new oil. I mean, the U.S. is producing some oil. It's not that they've produced none. Same with Canada here. We're producing oil. It's just we're not producing enough net. The reason that the U.S. and Canada are not having an energy crisis to the same degree and extent that Europe is that we could be self-sufficient. We can produce enough for ourselves, specifically Canada. We can produce more than we need. We net export. Whereas Europe, they are heavily reliant on, say, Russian pipelines and Russia for the supply. So, yeah. Inflation may get to 18%. If you're living in the UK or Europe right now, I think this winter we may see 18% inflation. It will be fucking hell energy crisis-wise if the tensions between Russia and Ukraine and Russia doesn't reach some sort of deal with removing sanctions. I could see it being really difficult this fall. So the government will continue to stimulate to help the people who are suffering the most, but that doesn't solve the problem because when they stimulate and step in to help, pay for utility prices or cap utility prices, and they start paying that difference out of the taxpayer dollar, well, now they've printed a bunch of money, so we get inflation again, right? You can't give people money and expect it to come from nowhere. The economy has to grow for money supply to grow. And we continue to grow, as a nation. We continue to be more efficient, and capital expenditure and innovation allows us to continue to be better and better at doing things for lesser and lesser capital inputs and labor inputs, specifically labor inputs, because of innovation, right, and technology. But we're not growing fast enough, and inflation is a result of what happened the last 2 years. So, and what is happening now. How do you become a mod? I can make you a mod. It's really easy. You can message me, you can chat about it. You can become a moderator. I can just literally click on you and I promote you to moderator, and then you have the ability to moderate my chat for me. Yeah, that's about it. Hey Mike, I bought an investment property with 5% down. Nice, pretty cool. Unfortunately, if you sell the property or refinance it, you'll get nailed in fees here in Canada. So don't refinance it, don't sell it. And then it was a great decision. No longer cash flowing with the recent interest rates. Shitty. It's not a big deal since the principal pay down is great and I can use the tax write-off. Is this a bad strategy? No, like you just outlined, even though it's cash flow negative, trying to sell it right now would make no sense. You put 5% down, the market's probably moved more than 5%. The bank probably has more than 100% of the value on the current mortgage balance. So you couldn't even get your 5% back. There'd be no reason to sell. You are cash flow negative, but as you mentioned, you're getting mortgage pay down and there are tax deductions. You can use your rental portfolio at this time to offset tax from your day job. I did it. I had 10 properties and I was making, my wife and I were making, I was making 55, 60. She was making 40, 100 together, and we paid almost no tax because our rental properties in the early phases were being stabilized. So I was evicting tenants, I was renovating and improving. And so I always had a vacant unit, which meant that because it was vacant, there wasn't enough income coming in to cover expenses. And I had a lot of expenses as I was investing in the property and making the property better, which I get back later. So I deferred tax. I paid no tax. That was how I built so much wealth so quickly, is I paid no tax till I was 26 years old. With education credits and everything else. I worked from 18 to 25, let's call it. For that 7-year period, I paid very little tax. I deferred. Now I pay a ton of tax, but Yeah, so rental properties, again, great tax deferral strategy. It is one of the best ones that exists. So I love having rental properties. I think that there's definitely some tax advantages, even if you're not cash flow positive. It is an asset class you should have. You should not be 100% in the stock market unless like you have emotional reasons why you don't want to have a property or whatever. But like there are some really great tax advantages. You can improve your property and then refinance that capital out tax free. You could put 100 grand into your property over 5 years, 20 grand a year, improve it up slowly, whatever. 1 year you do the roof, another year, you invest in painting all the units, whatever. Like as units turn over, you improve the building. You can pull that equity out tax free, but then you wrote off all those improvements. So you put 100,000 in your building, you got 100,000 in write-offs, let's say, or say 60,000 in write-offs, 40,000 was, you had to depreciate over time or whatever. So you didn't get to capture all of it maybe, but you captured a portion of that as a tax deduction. That can in theory offset almost all of your tax liability from your day job. And so for that 2, 3, 4 year period, you could pay deferred no tax. The same thing as the RRSP. Real estate has some great advantages in that you can refinance that capital, get that money back out of the property tax free. So again, I love real estate as an asset class for that reason. How do you buy wholesale deals with 29% down when the wholesaler wants 100% cash? I have to look at the specifics of the deal. I'm not understanding what you're wanting, but you're saying 29% down payment. Well, one, you come up with 29% down payment. Otherwise, you could do a vendor type of financing. But if it's a wholesaler, you're not really involved with the seller directly, so you'd have to bring an investor on, or yeah. Thoughts on garden offices? Bigger office spaces don't look to be coming back, but satellite offices, I love them. Big fan of the work from home movement. That said, there are a lot of jobs out there that don't make sense working from home, and people slack off and don't do a good job. So it depends. I think that if I had employees doing certain types of jobs, I'd want it to be in the office where they could collaborate with team members. So there is advantages, I think, for the employer and for productivity and for net benefit of society to have working in the offices. But there are lots of jobs that can be done more efficiently from home, and that extra commuting time for some employees it then gets invested into their work and they do better work. Some employees just screw the dog and don't do a good job. So it depends on the employee, depends on the job. Does it require a lot of collaboration? It's a lot harder to collaborate digitally, I think, than in person. You get less done, but it depends. The Phillips family says, bad debt at 3.5% interest. Do you pay it off or focus on saving for coming recession? Bad debt isn't at 3.5% interest. There is no bad debt, 3.5% interest. Any interest below prime right now is hella good debt. I would say prime plus 2 is good debt. That's my opinion. I guess it depends on the asset classes you're investing in. If you don't have great opportunities in front of you, and you're looking at like GICs, then even still, GIC is paying like 5, 6%. I don't know. 3% seems like good debt to me. I would keep that and not pay that off at all. I have no idea about the first home savings account. It sounds cool. I briefly read an article about it. It isn't going to impact me at all, so I didn't really go deep on it, but it seems like it might be a great thing for millennials over the next 5, 10 years, help them get into the housing market. At least they can invest like a tax-free savings account, but for the house, you can use your RSP too, do the same thing. So that sounds more like an extension of that, which is kind of cool. If you maybe put it in crypto during this bear market, it could like 5x, in which case like that'd be a pretty cool program. You put like 30, 40 grand into it. I think it's 40 grand max. And then it say 5x's and you have 200 grand tax free. That's cool. Catch you later, William. Thanks for the comment. What's up, Mike? Just say on live. Say you're killing it and keep up inspiring, brother. Thanks, Don. Lots of great comments here. Is this a good idea? Interactive brokers. So you want to get 80% loan to value mortgage and borrow the other 25%, 20% from interactive brokers. Great idea. Interactive brokers is at like prime minus 2% interest right now. Fantastic idea. Exactly. How many offers do you have to make before you get a good deal? You run the numbers, and if it is below the other comparables in the neighborhood and it's far enough under value, 100%. I got 3 other questions. Cool. Scrolling. Yeah, I did. Okay. Oh, how do you come up with 80% down? So 80% would be from lenders or the bank or private investors. There's lots of ways you can raise private funds. You could give up equity or you can secure a mortgage. All right, everyone, thank you so much for watching. I got to go. I'm late, super late for my daughter's bedtime. Remember, the secret to unlocking wealth through you is 3 levers. You are in control of your financial future. If you follow these 3 levers, you will become rich. Guaranteed. You work at McDonald's, over a lifetime, become a millionaire. That's it. Spend less, significantly less than you earn. And then work on strategies to earn more money, right? Spend less, earn more, and then maximize the returns on that difference. And as that difference grows, eventually, that will produce more than what you're spending. And then you can retire early, or you can continue to reinvest that and earn more money and grow to an abundance. Whatever you want to do. Ideally, you find freedom. I think once you've found freedom, you do what you love. So that's what I want for all of you. That's why I made this channel, was to help you guys get ahead financially. That's what it's all about. So thank you so much for tuning into the live Q&A. As you guys do every week, it's a great pleasure to be able to answer your questions and provide value. And hopefully someday there'll be an opportunity where you can provide the value back and we can work together on something. That's my hope with this channel. So thanks everyone for watching. I'll see you next week, every week, Wednesday, 7 to 8 p.m. Eastern Standard Time. I go live. I also post my stories like crazy on Facebook and on Instagram. You can follow me there. Yeah, thanks everyone. See you next week.